So what we're going to talk about in today's video is how we helped someone pick the right whole life insurance policy for their specific situation. They're looking at two different funding options. They're thinking, should I pay $50,000 per year into a whole life insurance policy where the cash value is the goal, or should I pay $25,000 per year into this policy? He's trying to figure out how to really nail the policy in order to get as much cash value as possible from start to finish. And here's why we're talking about this, and here's why we're looking at these two options. When it comes to option A, he says, I think that I can hit this number every year. It would be a stretch for me, but I think I can do it, and I like the idea of really building that cash value up over time. But I'm not sure. However, with option B, I know I can hit this number. Have you ever felt like that with something? Here's what I think I could do, but it might cause some stress. Whereas the other option, I know I can do that, and I'm not going to have stress at all. If you don't like stress, you've probably picked option B already. However, we're going to look at both options side by side and go over how we like to help people pick the right policy for their specific situation. Really, it comes down to this. Should he go with option B, which would be starting small, a small amount relative to his situation, what he's comfortable with, and then later, he could just get another policy. However, the counter argument to that is, if I just get a big policy now, that means I have room to add more money into this existing policy, and I don't have to get another one later. And why that's appealing is because anytime I look at a whole life insurance policy where cash value is my goal, the worst part about it is always the first year, because I have the startup costs, the insurance company and agent make the most profit then, like that's what happens with a whole life insurance policy. Whereas every year after the first year, the policy's compounding, I see my premium dollars and PUA dollars all come back to work for me, it's moving at a great pace, and I want to add more money. So if I go with the big option and add more money to it later, it keeps on compounding, and I don't have to deal with the startup costs again with the second policy. So he's looking at those and just thinking, how do I decide? What do I do? Here's usually what we like to go through. So what I like to start with is option A, which is a policy where I can pay up to $50,000 per year. So if I look at option A, what do we have here? So to start, we have a minimum, you'll see it in red, $5,000 per year. So that is his minimum premium. That is about what he is committed to every year. Meaning with policy A, he can fund up to $50,000 per year, but he's not committed to that. He's committed to $5K per year, and he can add an additional $45,000 per year at his discretion. And if he adds the additional funds, what happens? 5 plus 45 is $50,000. In blue, we see how much he's paying every year. And then in black, we've got the total outlay. So if he pays $50K per year for 10 years, he would have paid how much? $500,000. Why is $200,000 highlighted in yellow? Well, it's highlighted in yellow because if he max funds a policy, his break-even point, which is when his cash value is equal to or greater than his total payments, is the 4th year, which is really good for a whole life insurance policy. This is how we really maximize the cash value. And you could even improve that a little bit if you looked at a shorter funding period. Point is, this is option A, the option that he thinks he can do, but it would also be a little bit of a stretch for him. The death benefit is about $1.7 million. So before we just jump to option B, here's exactly how I would approach this situation. Option B was what? Show me $25,000 per year for 10 years. So what I would look at first is option A, this exact same policy, but with $25,000 per year. So what this means is I'm going with a policy that allows me to pay up to $50K, but I'm only going to pay $25,000. Let's see how it works. So what do you notice? Exact same base premium. However, the PUA rider is not the same. instead of $45,000 per year, it's $20,000 per year. 5 plus 20 is 25. Then when I look at the policy values, what do you see? Cash value in the first year is about 20 grand. It's 19,000 actually. Death benefit is exactly the same. This is still option A. These two are the exact same policy. The only difference is we're seeing what it looks like if I only pay in 25K, meaning I picked this option because I thought I could pay in 50, turns out I couldn't, I only paid in 25K, and now when I look at option B, I want to see how much it costs me, like how much am I going to regret this decision? Here we go. So here's option B. What do we see? Well, with option B, you see a base premium of how much? Not 5,000, but 2,500. Then you see PUAs, 22.5. Add the two together, you're at $25,000 per year. Then you've got your cash value and also your death benefit. Here's what I'm going to do real quick. I'm not going to look at that option on the far left. That's too much. How about this? So now you've got the same 25K per year. Same product with the same insurance company. The difference here is what? Death benefit, less with option B. Premium, which is your commitment, less with option B. The advantage to option A is if you want to, you have the option to pay up to 50K. So you've built in more window room to be able to add more money into this particular option. With B, we're maxing it out at 25K per year. If I wanted to do more than that, I would need to look at a second policy at some point in time in order to open up more window room. Which one would you pick? This might help. So this is going to show you how much more or less you have in cash value with policy B compared to policy A. So by starting with a lower death benefit and a lower minimum premium, but paying the same $25,000, in the first year, you've got $2,600 more in cash value. By the 10th year, you've got almost $12,000 more in cash value. It's because here you've got 291 versus over here, you've got 280. So the difference is just how much more you have in this column, in the cash value column. You've paid in a total of 280. I don't pay anything in after the 10th year. In this example, that's how long he wants to pay in. If I look at year 20, what do I see? $16,000 in change. Not that much, mainly because he's starting at 37 years old. When I look at this, I'd probably go with option A because the difference there is not drastic enough to say, hey, I'm losing a ton of money. I lose about 12 grand over 10 years, which is $1,200 per year. And I know that if I ever want to pay more than 25K in with this option, I've got the ability to do so. So I don't have to start a new policy to do that. And if I do add more than 25K, let's say I hit 50K during any of these years, say it's the first year and then the 5th year, it is really going to have paid off where I will say, hey, it's worth it because the extra money I got into the policy is compounding for me at an attractive rate. I'll look at the numbers, they'll speak to me and say, hey, aren't you happy you went with option A? That's just me personally as I look at these two. Everybody's different though. And it does depend on how much I'm paying into a policy, how long I'm paying into a policy, and that's just an overview of the exercise we like to take individuals through that are trying to figure out exactly how much they want to pay in and specifically know if I pick this big policy because I think I can hit this number, but it turns out I never hit it, how much does it cost me? And going through what we just went through allows us to see that cost before even starting. So I hope that this video was helpful. I'd love to hear your thoughts, and if you'd like to see more videos like this where we dive into the comparison or different comparisons and details, feel free to let us know your thoughts in the comments below. And as always, I hope this helps. Thanks so much.